Hello, hello, hello. Good morning, everybody, and welcome back to the weekly weekend live stream where basically everything is unedited, it's unscripted, and I'm here to answer questions and go over a couple key topics that you guys bring up to me during the week. And today we are talking about whether you should be shoving your money into stocks or real estate, especially during this time of the economy and we're moving into quote unquote flu season and election period and all this good stuff. And then we are going to talk about this huge push towards dividend investing and why it's actually not as great, and actually it's really bad. It's a horrible strategy that I see a lot of finance YouTubers pushing among people who are maybe not well educated in how balance sheets and statements of cash flows work and income statements, like the basics of analyzing businesses. So we were going to talk about that, and then last and not least, we are going to value Southwest Airlines because I believe I see some opportunity there. I did cheat a little bit. I took a look at the financials, and there's something a little bit different I want to show you guys, so you guys can use that new stock valuing spreadsheet that I created that some of you guys have already. And if you guys want to support the channel, I am actually going to put it on sale for 50% off today, maybe for this weekend. I'm going to do that right now, so you guys can go pick that up. I'll put a link. I didn't even put the link inside the description yet, but I'm going to put the link in the description so you guys can go get it. And you guys want to join us and you can follow along in how we value companies. And then you can take it on your own, value all the companies that you want, and see which ones are overvalued or undervalued, or which ones are fair market price. And hopefully you'll make your money back on that spreadsheet within the first trade. So let's jump right into it. But I am going to reduce the price right now. It's normally going to be $30. So the way that I'm going to do it is, you guys, I'm not here trying to rip anybody off. That's the last thing I want to do. And I will never sell anything or try to push anything out to my audience or you, the viewers, that I don't believe in. And this is something I personally made. If you're not happy with it or you don't understand how to use it, or anything, you can ask me questions. Please come to this live stream, ask as many questions as you want. And if you're still unhappy with it, let me know. I'll make it right with you. I'm not here to try to steal your money. I want you guys to be able to use this and make your own money. But okay, so it's 50% off right now. Let me get it up and let me get the, how do I, I'm going to, sorry you guys, I am trying to get, here we go. All right, I'm putting the link in the description right now. There you go. Live stream value spreadsheet. Valuation. Okay. All right, I'm back. What's up, Keyshawn? What's going on, man? So let's talk a little bit about, first things first, let's jump into investing in stocks or real estate, especially in this market where things are kind of really volatile, right? Now, we talked about this in the past where, if you guys watch any of my previous videos, especially go back to around like April, May, June, I was talking about how I thought there was going to be two big dips. One big dip was going to happen in July, and another one was going to happen right now, actually in October, at the end of Q3. And the reason behind that was because the writing was on the wall. It wasn't me just seeing it. Everybody that was in the professional field of finance or business could see the writing on the wall, was that the next 2 quarters and foreseeable quarters were going to be horrible. Sales are down. There's going to be mass layoffs. Debt's going to go through the roof. And the economy is all but shut down or basically grinding to a halt, right? We're definitely not growing. If anything, we're moving backwards as an entire economy and businesses. I mean, we're seeing the biggest, like basically bankruptcy of small businesses in the country that we've seen now in what, a 8-month time period. And so with all that said, the market should reflect that. If you're a company and your sales get cut in literally in what, in like by 80%, and you have to do a layoff of 30,000 employees and you pull out $10 billion in debt and government financing, the odds are is that your stock price is going to take a hit. Well, I was proven wrong. We were all proven wrong. For some reason, you can have all those bad statistics and all those bad balance sheet numbers, or whatever you want to call it, financials, and you can still have record high stocks. Now, there is a reason behind it. We talked a little bit about it in the last live stream, where basically investors, you and I, Robinhood investors, a lot of the mass market people, anybody who has a cell phone, so they can invest through Robinhood now. And we are becoming numb to the bad news. And we are so future focused that we're ignoring the basics and the essentials of basically fundamentals of business investing. And then number two is that the government just keeps bailing out the economy. Well, they're working on the second one, but they shoved a lot of money, $3.3 trillion, if I was to be exact, is how much they shoved into the U.S. economy within a 2 to 3 month period, which has never, trying to think about this, never been done before. It has been done where the government has stimulated the economy, but it was over several quarters, if not several years. Nothing like this done in one single quarter. So with that all said, at the same time, real estate was doing this awkward thing where it was actually increasing. So as people were getting laid off and people were losing their jobs and not being able to work, homes were actually increasing in price, and more people were actually going to be going out and purchasing homes. It was kind of odd because, strangely enough, more people were making more money and more people were having more time at home during the pandemic. And so it kind of like threw this curveball into the real estate market. However, it's finally starting to catch up because in my previous video, I showed you my rental properties are actually sitting empty right now or soon to be empty. Now, it doesn't mean I'm going to be losing money on it because it just means that I'm going to have to reduce my rental rates below market value. However, with that all said, below market value is still more than what I have to pay for to service the loan or to pay the homeowners, right? Now, with that preface, should you invest in the stock market or real estate? And I'm starting to see the crumblings of real estate at the moment. So I would say real estate, stock market's too volatile. That's my 30,000 foot headline approach to it. Real estate, not stocks. However, with that said, I would say it would be smart to do both. Now, real quick, with the 8 of you guys that are in here, if you guys could do me a huge favor, can you type in the comment section, let me know you guys can all hear me? That'd be fantastic because I only see one person typing so far, and I just want to make sure that everybody can hear me okay. So let's get into a little bit more of the details about whether stock market or what do you call it? Real estate, properties. Now, stock market, let's break it down first. Stock market, I would say yes, it's a great time still because what we're doing right now is we're trying to find the undervalued companies. And always in a recession, there are companies that people stay away from like the plague. Right now, it just happens to be banks, cruise lines, airlines, and a little bit of hospitality. A lot of the hotels and the hospitality stocks have gone up again, but there's still value to be made. Now, the thing that we want to stay away from, though, are like the stocks that are growing like at insane rates that don't have a lot of justification for it. Tesla, Apple, Facebook, Twitter, stocks like that. Now, not all of them are bad. It's just that there's so much hype built around the tech stock industry and the financials don't back it up is why I'm going to stay away from them because it's very volatile. That makes sense. So right now is a great way to cherry pick the ones that are very undervalued, doing your due diligence, how we value stocks, basically what we do in the live streams, and then slowly putting your money into the overall market. So like the index fund ETFs that we've talked about in a lot of the previous videos is slowly getting your feet wet in the market. Now, with that said, I would not put a lot of money in the stock market right now. And this is for my own personal preference and the way that I invest. And is that I do not consider myself a professional investor when it comes to the market at all, and I don't want to risk that much money in a market that I deem volatile. And what I mean by volatile is that it's overvalued. It's kind of like when you see, like if you understand like baseball cards or like any type of investment, and you're just like, dude, prices are ridiculous right now. I'm going to sit on the sidelines because I don't need to have that. I don't need to have that baseball card, or I don't need to have that one share of Tesla to make my ends meet. I'm going to sit back because even if I lose a little bit of money, that's fine. I don't want to lose my money though. That's the first thing about investing, is you always try to get your principal back. And then you focus on making money. The problem is when the risk is too high and the odds of you losing that principal, it's not worth it. That's why I sit out of the stock market or invest very, very conservatively into undervalued stocks. Now, stepping over into real estate or into homes and properties, I like that because I understand that and I have a lot more control. Whether you and the other hundreds of thousands of people that own Tesla stocks, if you guys all decide to sell tomorrow, I have no control over that. And it could send the stock tumbling down. But, you know, honestly, when you buy a piece of property and you did your due diligence, just, you know, the basics, it's very hard to say like 10 years from now, that property is going to be lower in value. You would really have to mess up really, really hard and miss some major signs to buy a piece of property now and not have it worth a lot or significantly more in 5 to 10 years. Okay, and that doesn't include the cash flows from rentals or the potential of improving the equity by doing a little bit of sweat equity. Okay, so that's where I come in, and I know how to finance real estate, and I don't really put that money at risk, right? So I could leverage $500,000 with only putting up about 10 to 20%. I wouldn't want to put $500,000 cash into a stock. Does that make sense? Okay, let me check over here real quick. Okay, perfect. Kenny, Anthony, Keyshawn, Sheila, Elazar. Thanks so much for letting me know that you guys can hear me. You're good, LC line. What's LC, Elazar? You have so much in... So quick question from one of our viewers. He has so much in real estate, and he's asking if he should hang on to his second home rental or sell. You know, if you feel confident or you feel comfortable, share with me the city, loud and clear. Okay, share with me the city, and if you want, if other people, if you're okay with it, share with me the Zillow link, and I'll take a look at it real quick. But right now, I would say hang on to it. If you need the cash and you want to cash out and move it into something else, like another piece of property that you see better value in, or you can create more equity, I would sell it, take that cash, do it. You can also use a HELOC, you know, take the equity out that you have right now and go purchase the other property if you can cash flow that current home, okay? It really depends on what your cash needs. If you don't need the cash, I'd say hold on to it, cash flow it, and then periodically make updates to it to increase your sweat equity into the property. Otherwise, I just, yeah, keep renting it out. Hey, Jen. Welcome back. San Diego. San Diego's tough right now because I know a lot of people are leaving Southern California. Actually, tell me, are people leaving San Diego? Are you seeing a lot of vacancies? Because I know typically, rough numbers here, 500,000 people migrate into California each year. And I think last year, the last 12 months, over 600,000 have left California. So there's they have a negative population rate right now, which I think is not very common for California. Correct me if I'm wrong with that. But going back on where to shove your money, I would say be very conservative with the stock market right now. You guys don't have to believe me. You don't listen to me, or you don't have to listen to me. But I'm telling you that it is extremely overvalued. Just look at the PE ratios. Look at how much cash these companies are bringing in. Look at their debt levels. Look at the what do you call it? The layoffs that are occurring across the board. Like Disney just laid off 30,000 people, and then they're trading higher. How does that work? I lay off 30,000 people from my workforce. I bring in crazy amounts of debt, but my stock price goes up through the roof. Doesn't make sense, you guys. But in real estate, what I really want to get into is that the cracks are forming. I made 2 previous videos about it, and let's get a little bit more into that. And so if you can find a way to get into the real estate market, and I'll create a video that talks more in detail about that, but the thing that I love about the real estate market is that you can leverage a lot of money with relatively low amount of money. So for example, like I just said, is that I could take $100,000 cash and I can leverage up to $500,000 because I can get that in the form of a mortgage from a bank, right? So I only really have to come up with 20% to leverage $500,000. The great thing about that, when I go into a home, I put in sweat equity. This is where it takes a little bit more hard work, where if I want to replace the floors, I do new paint, I might separate out a room, I'm going to do some basic touch-up stuff. sometimes some renovating if the dollars make sense. But what happens is that I use $100,000 to leverage all $500,000. You guys got to remember that the home is worth $500,000, and if I increase the home by 500 or by 10%, let's say I clean it up, I do new siding, new roof, whatever it is I do, is that it increases the home by 10%. That 10% is on the 500,000 that I leveraged, not 10% of the $100,000 that I had to put up to pay. Does that make sense? And so you're actually, when you're dealing with property, you're playing with a lot more money than you actually have. And that's what I like. And I like the fact that I know when I go into, let's say that I have to remodel this house here or this floor or whatever, and I put new baseboards, I put in new flooring, and I put on fresh paint, and I replace all the doors and the door handles. That would cost me, I'm a ballpark here, maybe between $3,000 to $5,000, and about probably 2 weeks, maybe 3 weeks of work for me. Okay, I know that's going to increase the value of the home by probably, I'm making numbers up here, depending on the market, depending on the type of home, but let's say that that $5,000 investment increases the home by $20,000. Okay, new floors, new walls, new trim, new doors, new door handles. That's a pretty dang good return for 3 weeks of my time and $5,000 investment. And now you can think about how I escalate that by, hey, let's reside the whole house and do all new insulation. Costs me $40,000, but increases the value of the house by $100,000, $110,000. You know, let's add a new shop. Costs me $30,000, increases the value of the property $75,000. You do that over and over and over again, you start realizing how quickly the money adds up. That is just in the equity. I can rent out these homes for more. So I originally buy it, I can rent it out for $1,000. I do all this equity or all these improvements to improve my equity, sweat equity, and now I can rent it out for $1,300 a month, $1,500 a month, right? If I short-term rent it, like I like to do, now I can, instead of making $1,000 a month, I can make $3,000, $4,000, $5,000 a month. So you get this reoccurring monthly cash flow, and you got sweat equity, and that's what I do in all my. Basically, that was my whole MO through my 20s, is that I try to short-term it, make between $5,000 to $10,000 a month, and then I have hundreds of thousands of dollars in sweat equity. And that's exactly what I did. This is my personal home that you guys see me in, that I also have a rental apartment on. That's exactly what I did. I spent, I'm very transparent about this, I think I spent a total of $375, $400, well, no, sorry, I just reset. So about $410,000 total. The property's valued probably close to $1 million right now, maybe just shy of $1 million. And I cash flow $3,500 a month. So $3,500 a month, no mortgage, just taxes and road maintenance. I got road maintenance. But basically, let's say $3,000 a month. So I make $3,000 a month off one property, and I have roughly, let's say, $500,000 of equity in it. And that's what you. And that's why I'm so attracted to real estate, is I have way more control. The burn is small though. Now, a lot of the day traders or other stock investors, they're like, hey, I can buy options, I can buy puts and calls, and I can do day trading or invest in penny stocks, and I can make that money. Yes, absolutely, you're right. But again, we go back to the point, as a sound investor, I'm always trying to protect my principal. If you have $100 or you have $100,000 or you have $1 million, you protect the principal at all costs, right? And so it's not worth it to me to risk $100,000 with, let's say, a 20% chance of doubling it if I invest in penny stocks. Because what that tells me is that I have an 80% chance of losing it all or even going into debt. With property though, when I do my due diligence, if I put $100,000 in a piece of property, my odds of winning, cash flowing, or at least keeping my money is at like 95 to 98%, maybe even higher depending on what I do and what property I buy. So my success rate is almost a guarantee. And even though the payout will be a little bit smaller, or maybe way less smaller, or it takes way longer, I'm willing to take that longer bet and just do more of those deals to guarantee my principal is safe. Does that make sense? And that's why we're going to lead into these finance YouTubers. And for the folks that are in here, I'm going to give you a little bit of a secret here, is that be very, very careful when you watch channels like mine, including myself. I'm not saying that I'm anything special, but when you watch YouTube financiers or financial YouTubers, is understand their background and see where they make money. The biggest thing, the biggest problem that I see a lot of people do is that they trust folks who didn't make money through finance or investing. A lot of YouTubers out there, they made their money through YouTube. So they're making videos. I'm like, hey, I bought this phone on Amazon for $10 and I'm selling it for $800. Look at what I can do. And you click on that and you watch it, and they did somehow buy an $8 iPhone and sell it for $800. You're like, oh, that's really cool. They subscribe. They're making money off of advertisements, any courses that they have or anything like that, and their net worth goes up. And so you see that when they show like, hey, look, this is how much I make $10,000 in passive income, da 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 da. They make their money off of YouTube. They're not actually creating sound investments to make money. Does that make sense? And it's like this weird cycle where they end up showing $20,000 a month income and passive income through YouTube ad revenues, but they really haven't made a dime through real estate, through investing in the stock market. They have no formal training in understanding financials, but then they come and tell you, invest in these stocks because they're good companies. And that's where I'm gonna call them out. I'm not gonna name names. You guys know who you are. But real quick, let's jump over here. Let me see if anybody, no more questions. Hey, everybody in here real quick, do me a huge favor. Let's see if we can get a bunch of likes. There's 11 of you guys in here. Let's see if we can get this over the channel or the live stream to over 10 likes. Can we do that, please? I'd appreciate it. Thanks. Okay, let's talk a little bit about, real quick little plug for me. Get your spreadsheets warmed up, pull them up. Anybody who hasn't gotten a spreadsheet yet, I just put it off 50% off. It's only 15 bucks. The link is in the description. Buy it, and then you can follow me when we value Southwest. I promise you, if you guys figure out a stock to buy, this thing will pay for itself within your first trade. And again, as always, not trying to steal your money, not trying to pull the sheep's wool over your eyes. If you guys don't like it, or you guys can't use it, or you guys don't understand it, let me know. I'll make it right with you. I'm not here to try to steal 15 bucks. I want you guys to feel like you guys are getting good value from it. Okay. With my whole rant on other financial YouTubers that make their money from YouTube creating content but never made money really doing rentals or stocks or investing or anything like that, one thing that I've been seeing a lot is dividend investing. And this is the reason why I cringe every single time I see it pop up. And you guys know who you are that are out there. If you guys are watching this, probably not. You are doing a disservice to YouTubers and other people trying to learn. Okay, so a lot of people will show their Robinhood accounts with $100,000, $200,000, $500,000, and they're like, hey, look at my long list of dividend stocks that I invest in. This one gives me 7%, this one gives me 9%, this one gives me 20%, whatever it is, right? And they're like, look, because I have invested, we'll use simple numbers here, $200,000 in Robinhood into these dividend stocks, and then I'm getting an average of, let's say, 5% a year. I'm passively making, what is that? That's 20,000, 10,000, 10,000. So they're making roughly $1,000 a month passively off dividend stocks. And people get pulled into it. The problem with that, though, you guys, is that you're looking at one number of a company. And a lot of these dividend stock investors, what they're doing, and I'm sorry I'm getting a little bit upset here because it hurts people who are trying to learn, and I hate it, is that they're looking at one number, actually two numbers. They're looking at the dividend rate, right, which is 2%, 3%, 4%, all the way up to sometimes I see as high as 9, 10, 11%. But it's based off of the current price of the stock. And so if the stock just took a huge dip and they haven't changed their dividend rate yet, then of course it's going to look really high. No company wants to give out dividends because if you guys think about it, fundamentally, when a company gives dividends, they're giving cash out of the company. So if I had, like, let's say my channel, Kai Andrew, is my company, and I give you viewers my cash in dividends for watching my videos, which sounds pretty cool, right? That's a backwards way of doing it, but that'd be an interesting model. Is that I don't have money now to pay for the subscriptions for the music, to pay for new microphones, new camera lenses, new software, all this stuff, right? Because I'm giving that cash to you. Now, if I kept doing that at a really high rate at, let's say, 10% of my income, my revenue, not in my cash flow, my revenue, actually it's off earnings, so that's not fair to say. So like, let's say I give 10%. It's not realistic. So you're putting money, you're putting tens of thousands of dollars into a stock that has a 10% dividend rate, but then what you don't know is within the next quarter or two, they're gonna drop it back to a reasonable dividend, right? Now, the other part of it is the fact is that these dividend investors, they hold like 20, 30, 40 different dividend stocks. And they definitely did not do any of the valuations that we do in these live streams. And what they're basing it off on is, one, is they look at the dividend number, the percentage, the yield. Two, they look at the history of the company. And this is what frustrates me the most, you guys, is when we study stocks, we use the history to make educated assumptions on the future. And we also take current performance to make educated performance of the future. Looking at the history of what a company did in the last 10 years, paying out dividends or being a good company, does not reflect the future. It is not a direct mirror image. It's kind of like, I always say it's similar to like roulette. If any of you guys have gone to the casino or gambled, you know that roulette table or the roulette table with that screen that shows you like the last 50 numbers that were that had came up, and you're like, oh yeah, I see a bunch of reds or I see a bunch of blacks, or it looks like it hit these numbers a lot, and then you base your information off of that. That's all play. It's all just for show, because in the roulette, even if it hit black the last 5 times in a row, so you think it's going to hit red the next time, each time that roulette table goes, the odds are the exact same. It does not matter what's on that screen, okay? And that's similar to the stock market. What Apple did in 2010 is not anywhere indicative of what's going to happen in 2021. The dividends that they paid out last year does not prove evidence that they will pay a dividend this year, because it's based off of business principles, who's in leadership, and if they're profitable, okay? So with that rant, remember, be careful of dividend investors. Oh, the last thing before I jump into that, or I jump over to the next thing, we're on Value Southwest here, is the biggest problem with dividend investing is if you put $200,000 into 20, 40 different dividends stocks, is that you make 5%. Let's go outrageous, and let's say that you get 10%. Something completely crazy that probably will never ever happen is that you average a 10% return or yield by investing in dividend stocks. All it takes is for your overall portfolio to go down more than 10% for you to lose all of those earnings, that passive income. Does that make sense? So if the market goes down by just 10%, which is completely plausible, you lose all of your passive income. Now, when you have a portfolio of 40 companies that you didn't do any research on, how likely is it for 1, 2, maybe 3 companies to lose more than 10% in the next, say, 12 months in this uncertain market? It's very, very high. And that's why dividend investing is ridiculous, and you should stay away from it. What you should do is, when we do these valuations and you find a good solid company with good fundamentals that happens to have a dividend because they have cash to the bank to pay out to investors, then yes, that's a good investment. Maybe even pay a premium because an Apple or a Microsoft pays a slight 2% dividend each year. But don't just go putting your money in Joe Schmo real estate stock because it has an 11% yield. Those YouTubers, the crazy thing is that those YouTubers that are like spouting out this like disinformation or whatever you want to call it, they have hundreds of thousands of subscribers, tens of thousands of subscribers, way more than my channel. And that's what frustrates me, is that they're reaching a wider audience, spreading bad info. Okay, enough of that. Enough, no more hate. No more upsetness or frustration. You guys get it. Okay. Oh, my cousin's watching. Hey, if you're watching this right now, he just joined the Space Force. If you're watching, yes, if you send me a t-shirt, I will absolutely wear it on YouTube. I'll wear it live. I'll wear it all the time. He just got accepted to Space Force. Can you guys believe that? just a couple days ago, I was actually looking at joining the Air Force because I want to work with the Space Force. So nutty. All right. Hey, we got to 10 likes. Thank you, everybody. Now, all you new viewers in here, let's see if we get to 15 likes. Please like the video. I appreciate you. Thank you so much. Okay. Any questions that you guys have, put it in the comment section as I pull up this next stock here. So, as we're going to do, I'm going to share my screen. I'm just getting everything prepped here so it'll be as flawless as possible. So, we're doing Southwest today. And the reason why we're doing Southwest is because a lot of times in recessions or in bad markets, there's always going to be gaps to be filled. There's going to be like the low companies or industries that nobody wants to touch. Back in 2008, it was basically any type of investment company or a bank, right? Investment banks. They were basically Goldman Sachs. Think about Wells Fargo, Wachovia Bank. I had a lot of money in them. They disappeared. And right now, like I said at the beginning of this video, is that it's airlines, cruise lines, banks, and then some hospitality industry or companies in the hospitality industry. I can't talk. And Southwest is interesting to me because their stock price is still at close to all-time lows. I think they bottom out right around $25, $26. They're currently trading at $38, I believe. Their highs for the year was at 70. Could be wrong, somewhere around there. We'll take a look here in a second. But like I said, history doesn't really serve its justice. It just kind of gives you a preview of what could happen. Is that a lot of airlines are not doing well. And I've always been a fan of Southwest. I know a lot of you guys out there aren't. But I do like their financials, or we're going to dig into it a little bit more. But also why we're going to dig into them is because their financials are a little bit tricky. Do you guys remember when I was telling you about the spreadsheet? I set it up so you can value 90%, 95% of companies. But every once in a while, a company will have just weird financials. And they'll label things weird, or they don't put things in the right spot. And it's hard to pull. And Southwest did that. And it kind of screwed up the spreadsheet. But I'm going to show you guys how to overcome that, okay? Now, what I'm doing is a lot of times when you're about to invest money into a stock, especially a lot of money, is that you do research on the company. And I don't just mean research like what we're doing. You actually go and experience the company. So Home Depot, I have a lot of experience with it. I go in there and, man, I have a good relationship with the pro team there that works with me when I do my projects. I dig deep into their psyche and what's going on behind the doors. That's me doing research. I'm going to be doing the same thing with Southwest because I'm flying out to Austin in 2 weeks? No, 4 weeks. 4 weeks I fly out to Austin. The reason why I'm going to Austin is I've got a business opportunity out there. I might be actually starting custom building company out there. I have a good friend out there that I went to grad school with, and he's a builder. Anyways, we'll talk more about it at another time. But there's a build opportunity out there, and there's a business opportunity that I'm gonna go out and check out. Look at some land. You guys know I want like a ranch out in Texas, so I'm gonna go take a look at that. But the other thing I want to do is I'm flying Southwest. I never fly Southwest because usually they're the most expensive. I usually fly, what is it, Frontier, sometimes even Delta, I think. Or Alaska is a good one. But I'm flying Southwest this time. Actually, prices weren't that bad. And I'm going to do a little bit of research or reconnaissance on how they run things. Every single time I fly Southwest, I'm very impressed. But I want to see how they're doing things in this coronavirus pandemic, because I know they're starting to take over a lot of other hubs and other airports where companies are struggling. U.S. Airlines, U.S. Airway, is that one? United. There's one other one that's struggling right now. It might be Spirit. But where those companies are basically slowing down and not able to kind of step up and fill, other good companies will come in. And I think the best companies that I've flown, Delta, Alaska, and Southwest, domestically anyways. All right, so what we're going to do here is everybody pull up Morningstar. And what I'm going to do is I'm actually, before I switch over the screen so you guys can see, is I love the ticker symbol too. Ticker symbol is LOVE, L-U-V. So I'm just pulling that up, and I don't know what's going on with my computer right now. For some reason, the spreadsheet goes incredibly slow. Let me know if you guys have that problem too when I have like 5 spreadsheets up. So I'm just gonna pull the financials right now and get that all situated before I actually pull up the valuation spreadsheet. So I'm just gonna go to my income statement real quick here for Southwest Airlines, export to Excel, get that open. Now another thing that I want to touch base on real fast as we're pulling this up, I got my income statement up, going over to my balance sheet now, export, is that remember when people give you advice or they're talking to you about, hey, look at my portfolio, look at my Robinhood, look how much money I made, look, I'm right, I invested in ABC company and it's up X%. We are in a market where it's a rising tide, right? The FANG stocks, right? What is that? Facebook, Apple, Alphabet. What's N? Google. I can't think of N. Is it Nvidia? FANG. I'm missing N. Amazon. I can't think of it. My brain just lapsed. But those companies, the core companies that are doing really well, they are creating this huge wave where all stocks are rising because all investors are really eager to get in because those companies actually are making a profit. Those 5, 6, 7 companies are doing well. The thousands of others are not. So just remember that right now when people are showing like, hey, look at, I turned 20,000 into 100,000. Remember this market is an anomaly. They do that into perpetuity. They do that for 10 years. They end up losing money. So don't take a person's like little snapshot of a 3-month anomaly as that's an educated person or that's a really good investor. Because I wouldn't even do that. I would say like, hey, take a look at my entire portfolio over the last 15 years. Look at over here. I was losing money during these 6 months, but then I made a lot of money here. So yeah, you can take snapshots and see that I did really well at certain times. But I wouldn't say that I'm awesome because I made a lot of money in 6 months. I'm like, take a look at the last 6 months. I lost a crap ton of money. All right. I am getting my statement of cash flows pulled up. And if you guys remember, you got to convert all those little green triangles to numbers. I know you guys can't see the screen right now. I'll share it with you here just in a second. I want to get this situated first. Convert to numbers. All right, let me move this over. I'm going to shrink this down. Put that right here. All right, you guys are going to be able to see this real quick. And transition. Boom. Let me move this over a little bit more. There you go. Okay. So remember to do this. So I just pulled my financials right here. Let me move this over. This right here. This is just Southwest Morningstar. You guys remember to do this. Get your spreadsheets up. If you guys haven't done your spreadsheet yet, link in the description. Follow along. If you don't like it, I'll give you your money back. Don't worry about it. But so what we're going to do here is we went to Morningstar, typed in LUV or Southwest Airlines. We went to their financials, and we're going to pull their 3 statements, okay? I'm just doing this ahead of time. You guys can do it in any order you want. This is the way I like to do it. But remember, we always have to convert their numbers or convert the financials into numbers because these are actual formulas that are basically throwing an error message. And so we don't want that. We just want the numbers. So I'm doing that. And the reason why I'm doing this before is because when I have all these spreadsheets up, and especially the other one that is really macro and formula heavy, it slows everything down. So I'm just prepping this. Okay, so I got the income, balance sheet, statement of cash flows. I'm pulling that away, and now I am opening. If I can find it, where did I put it? There it is. All right, I'm opening the valuation spreadsheet. And remember, we're always going to enable macros. I'm going to move this over. Boom. Let me zoom out a little bit here so I can see a little bit more of it. Sometimes I just have to let it think for a little bit. All right, there you go. All right, so first things first. And oh yeah, by the way, if you guys do end up buying this spreadsheet, I actually created like this whole instructional step-by-step PDF. So you're not going to be flying blind. You don't have to just like watch these videos over and over again. I'll actually walk you through on how to value a company. So first things first, always save it. So we're doing Southwest, so we'll do Southwest. And then I like to put in the date so I know when I valued that company. So today's the 17th, I think, right? Yeah. So I'd put Southwest 10/17/20, and I just save it. And now if anything goes wrong, we know that we have it. Okay, so what we want to do is very beginning, we start the dashboard, and we do discount rate and Ebitda multiple, remember? No problem, Kathy. Welcome. Hey, Jen. Jen F just jumped in. Zach, what's up? Anthony, already talked to you, or already saw you. Netflix, we'll take a look at Netflix. Real quick, let me just answer Zach's question here. Hey, by the way, do you watch economics? I do like the channel Economics Explained. He actually does a very good job. I did not watch the video on unprofitable companies, but I will look into that now. I'll make a note of it right now. Unprofitable companies. Yeah, there's a whole industry and strategy for CFOs of companies who are unprofitable, how they make money. I think one that's getting a lot of press right now is Dan Blazerian with his company Ignite. I haven't looked much into it, but they were unprofitable and it's finally catching up to them. Oh, Netflix. Thanks, Anthony. You're right. Yes, Netflix is the N in FANG. Thanks. Okay, so back here to the discount rate. So if everybody has their spreadsheet up, remember discount rate is the risk rate. So when we're valuing Southwest here, it's like, what is the risk of this company not panning out the way that we see it? Now, typically, I won't go in depth with it, but if you guys click on the I right here for information, it'll give you more of an explanation on what discount rate is. The base rate for discount right now, I'm keeping at 0.5%. That's the risk-free rate. If I put my money in a 10-year treasury bond, I can expect about 0.5% back per year. So the discount rate for Southwest, I would say, being that it's an airline company right now with the pandemic going on, I truly believe the worst is behind us. I think that we're just going to be in this muddled, gray, dirty, nasty zone where it's kind of like back and forth. I don't think that we're going to see this huge, dramatic spike anymore. So I think that we're in the clear. I could be wrong. Most companies are between 5 to 10%. I would say I'm going to give them a 5.5. So I'm giving them 5% risk of not working out, basically not hitting any of the assumptions that we're going to put out here. Okay. Now for Ebitda multiple, what this is like how many years after can they continue to grow based on our assumptions here in a little bit. So basically, we put our assumptions out to 2024, right? 2025, I believe. Should be just 5 years. Let me see. 2024. So basically the beginning of 2025. So how many years past 2024 can this company continue to grow based on what multiple we put in here? So if I put in 2 multiple, basically it's saying that it can continue to grow at this rate until 2026. And then if I put 5, it'll be till 2029. Does that make sense? The standard for a publicly traded company is anywhere between the 5 to 8 multiple range. With Southwest and where they're at right now, gosh, it's all over the board. I would have to give them, I'll give them like a 6.5 times multiple, maybe 7. Once we dig into the stocks or the financials a little bit more, we might adjust that. But right now I'm at 5.5 and 6.5%. Okay. The next thing that we need to do is we need to input some just really basic stuff. Right here, the green area, it's really easy. That's the only places that you need to put in the data points that we need. But first, I'm just going to put Southwest right here so we know what we're working with. I like to put in the ticker symbol. So we're going to do current stock price. So the first thing that we do is we come over here. We go back to quote in Morningstar.com. This is a completely free site. I'm not sponsored by them in any way. I just generally like using them. Stock price right now is $39.68. So I put in here $39.68. I look at outstanding shares. You click on short interest right here. Now, the one thing that you have to remember is that all financials and the spreadsheet is based off billions, okay? Sometimes they'll give you numbers in millions. And so what that means is that instead of dividing, like, you guys know how that works, right? I'm not going to explain it. So right now it's 589.87 million, but that's only, let me move this so I can see it better. Just resizing this. Outstanding shares, that's 0.58987 billion. Okay. The current PE ratio, all we gotta do is go back to financials. We look at right here, 116.28 right away. That shows that they're really overvalued. What that means is for every dollar the company makes, the market is valuing them 116 times that dollar. So Southwest would give an investor $1, that investor would give Southwest $116. That's really expensive. Again, market average during typical times is 15 to 20x. Companies that are really, really great companies that have a lot of sound fundamentals and making a ton of cash, they can trade at a premium between 30 to 50x. Anything above that starts getting into the ridiculous realm. Okay, going down, we got to figure out cash now. Really simple. You just scroll down to the balance sheet right here. You look at cash and cash equivalents. Again, it's in billions. You see this huge, and one thing that we always look at, you always pull from this right column because this right column is going to tell you the most up-to-date numbers. So they're at 14.46. Do you guys see anything funny or kind of odd here? Right? They were floating around the 3 billion, 4 billion range for the last 3 years. All of a sudden, it spiked up 10 billion. Where do you think that money came from? Probably the stimulus package and debt, right? So that leads us to the next thing is let's take a look at their amount of debt. Yeah, we can see it right here. Boom. So their total debt is the same thing, around 3 to 4 billion, and it spikes up to 11.5 billion. So they got about, what is that, 8 billion in debt, and their cash increased by about 10 billion. So what I'm thinking is that they pull out 8 billion from the government or from banks or whomever, and then the last 2 billion they probably got from investors or from lines of credit or something. They pulled another 2 billion from something. We'll dig into that and see if we can figure out where. So total debt here, we're gonna put 11.42. Now right here for the sales growth, we're not gonna do that yet. That's for later. I wanna take a look at the numbers first, and then we can assume and figure out the sales growth. And this is where other financial YouTubers, not all of them, there's actually some really good channels out there that do the fundamentals just right, and they have way more experience than me. I'm picking on the channels that are just kind of out there for the fluff and for the views that don't do this. This right here makes or break everything, okay? So whenever it comes to, well, discount rate and EBITDA also, but we'll play with it here in a little bit. I'll show you how big of a difference sales growth plays a factor, because what you're trying to do is you're trying to predict or project out the future of the company. A lot of companies or a lot of people, when they look back at the history, like, oh look, Apple did this in 2017, and then they did this in 2015, and then they did this in 2012, so therefore it's a good company. No, I gotta know what Tim Cook is doing. They're releasing the iPhone 12. What's the reception like? Do people have money right now to buy an iPhone 12? Are they expanding the market? It looks like they're creating more phones for different people at different levels. They're not just going to have this crazy, $1,200 phone. So that is all factored in to the sales growth, and that will dictate the true value of the company. So let's start putting this in. So right now, we're going to do the income statement first. So all I'm doing is I'm coming over here. You start up here in A1. You click and drag. You copy. Come back over here, and you always paste in column or cell C3. Okay, paste. Done. Go to balance sheet. Where's my balance sheet? Did I lose my? Oh, there it is. Okay, go to my balance sheet. I do the same thing. Copy. Paste in C3, and then now I'm going to go to my statement of cash flows, and I'm going to do the same thing. This is my statement of cash flows, A1, copied it all, paste, boom. Now, like I said earlier, I did look at this already. I already know that we're going to get an error message, okay? So look at this. Oh, we didn't. Oh, well, we did. Right here. You see this? Boom, boom, boom. So, sorry guys, my spreadsheet's thinking. So we do have a couple of error messages here. The main ones are down here where you guys can kind of see where it's not actually spitting out a price per share, the difference in price or anything like that. A lot of that has to do with all of this right here that you see. And this. Tax shield, IEV, price per share. Because these are all tied together. And the reason why, so when I'm looking through this, and this is why it's so important to double check, because like I said, these companies don't work together. They do have to adhere to something called GAAP accounting, which is generally accepted accounting principles. And that's what these financials are. All these financials is a certain way they do it. With that said, they don't have to put the numbers in the exact right spot, and like how they define things can be very murky, and that's why sometimes the numbers are messed up. And so when we double check it and we take a look and see why this is all messed up, we see that for one, I noticed right away that the tax shield and IEV, which stands for intrinsic enterprise value, is not working. Therefore, it won't give me a price per share. The other thing that I see right away is that they have no SG&A costs. You guys see that? It's like it's empty. So let's dig into that first, because that's weird why there's no SG&A, which is sales, general, administrative. It's basically how they run the home office, how they run the overall business. Why is that zero? So we go to income statement. And right away, what we're going to do is we're going to look at right here. You see that? They left it empty. They also left depreciation empty. So I don't know what they're doing. I'm not their CFO. I'm not their accountant. So I don't know. My job, or our job as investors, is to dig in deep and see, like, what are they doing? Why would they do that? Like, what's going on? And so when we're doing this, like, we know that they have depreciation. They have planes. They have what, hundreds of airplanes, and they have to have hubs. They have to have factories or something, or warehouses. So they have depreciation. Why is it zero right here, right? And then why is sales, general, administrative, staff costs? That's all things that all companies have. Why is that zero? That's the reason that we need to dig into. So just taking a quick look, I'll save you guys time, is that they put it up here. They labeled it differently. They labeled it as operating income and expenses. So it's right here. So I'll just highlight that orange. And then you can see they put depreciation right here and staff costs right here. Whoops. Now typically that stuff would be in SG&A. However, because of how their business works and how their accountants want to do it, they put it into COGS, which kind of makes sense, because remember, COGS is cost of goods sold. They are selling a service to fly people. Basically, that's what an airline is, right? They fly you across the country, across the ocean, to new places. And so they are defining COGS as staff costs. It's the cost of the revenue. Because I'm assuming this is airline pilots, flight attendants, maintenance, crews, that type of thing. That's fine. If they want to do that, that's fine. We just have to hold it stable for everything else. But the thing is that we need this number right here. I shouldn't highlight all this. I'll unfill that. This is SG&A now. Okay? They just labeled it differently. And they said COGS is cost of revenue. It's actually just COGS. Again, different word for it, or different title. So we need to change something in our formula, which is actually really simple when you guys see it here. Do you guys see this right here? I just went to the helping sheet. Actually, I'll go back to the income statement real fast. We need to copy this cell right here, this label. And if you guys ever have questions about this, you guys can literally email me, message me, DM me, and I'll help you out right away. This is where it's pulling from. Our main report is pulling from right here. It's going cost of goods sold, goods and services, and it's looking for that. It's looking for this in the income statement. So it is looking for SG&A, and it's looking for this. But in Southwest, it's not pulling that. So what we're going to do, I hope this works. If it doesn't work, I'm sorry. We're going to have to put it manually, but let's hope that this works. We put that in here like that, and fingers crossed. Didn't do it. Why didn't it do it? Now I look like a fool. We put selling general administrative expensive operating expenses. That means it's supposed to pull it from there. It's going to pull it in here. You know what? I'm not going to even sit here and try to. Let me try one more thing. SG&A. Income statement. I did it right. There's no extra spaces. I copied and pasted. It's right there. Hang on one second. Let me see what I did over here. Enable. Hold tight. I'm troubleshooting. All right, let me see if I do this. So we go over here. Okay, I know what I did. I know what I did. I got it, you guys. I got it, you guys. So how this works is that this is already here because it's operating income and expenses. So long story short, if I wanted to pull operating income and expenses, I can just type in operating income and expenses into the report page and it'll pull it. But since it's already pulling right here under a different label, that's what's messing it up. So what we need to do is we need to copy this and put it here. Does that make sense? Because how Southwest Airlines is identifying this is they're using this tagline or this subheader is how we define it. And we're going to put that under here. We go back over to report. There you go. Now it pulls it. Okay. Slight panic there. So if you guys go to your helping sheet, anybody who's following along, go to your helping sheet and just change that operating income / expenses. Just copy and paste the cell below it and paste it up there. And it's going to plug it in right there for you. Okay. Make sense? All right. Now let's hunt down the ask questions. You guys have questions, let me know. Now the next thing that we need to see is, you guys see what says like hashtag div over 0? I'm not sure what that means. It just means, oh, it means that you're trying to divide something over 0 and it's not working. It's throwing an error message. And so whenever you see that, just know that there is a mess up with a division, like something's going on. And so what's happening here is, I can tell you right now, it's almost always related to debt. And this is an error that I'm not sure how to fix. Excel wizards out there, let me know. But basically, we are taking a company that had 0 or very little debt, or they weren't paying basically principal payments on short-term debt or long-term debt or whatnot, to all of a sudden they have a lot of debt, and somehow in that balance, it's showing that they don't pay interest, but they have a lot of debt. So they're not paying principal, and so you're dividing by 0 at some point in time. I probably didn't explain that very well, but that's why it's throwing this average interest on debt. Is you can't do it. It's showing you can't divide by 0. So we're just going to dig into that a little bit. So we do see that they did have interest payments. There is a tax shield. They did not do any principal payments to short-term debt. So I'm going to dig into this a little bit more. Interest payments. Okay. See, now we're getting somewhere. That's interesting. Why is this showing no long-term debt? So this is where we become sleuths. I kind of like, it's kind of like being Sherlock Holmes. So like, you guys remember this when we're looking over here? You see how it shows debt, 3.67, 3.38, 4, and then 11.42? Right away, I'm wondering, why is it showing long-term debt right here? It doesn't show any long-term debt. So let's jump over the balance sheet. Let's see if we can hunt this down. So the balance sheet is where the debt is held. See? Look. I don't know. So again, this is their CFO, their accountant's doing something, and we just have to figure it out. So right now, this is why it's showing there's no long-term debt, because in the report or our formula, it's saying whenever you see long-term debt, pull that number. And it's showing, for some reason, they're showing they had no long-term debt. Even over here, it shows that they do have, oh, that's total debt. So maybe it's a lot of short-term debt. So let's take a look at that. So there's long-term debt. Where's their short-term debt? Current portion, current debt, current portion, and long-term debt. What? They don't have any short-term debt? They have to have short-term debt. Am I just missing it, you guys? Current debt and lease obligation. Current portion of long-term debt. I don't see short-term debt. But report said there is short-term debt, right? Short-term debt right there. 0.64, 0.57. Oops. 0.64. Oh, so it's pulling this. So current debt, remember, current debt is anything within 12 months. However, this is kind of messed up because it's current debt and capital lease obligations, current portion of long-term debt and capital lease, current portion. So you see how this is zeroed out right here? What? God, they're so confused. I don't know what's going on. So the confusion is right here, you guys. And this is not the spreadsheet. This is just companies doing weird things. So basically, each time you see this tab over, it's a subcategory of the top one, right? And basically, wherever the numbers end, that's where it tells you what is actually where that number belongs. So this is obviously the overarching umbrella is current debt and capital lease obligation. That's basically rent. And then you go down, it says current portion of long-term debt. So that means debt that's due, long-term debt that's due within the next 12 months, and capital lease. You're like, okay, so they mixed it together. And then you come down here and it breaks it apart even more between current portion of long-term debt and then current portion of capital lease obligation. It's 0 and 0. But somehow they have $637 million worth of current portion of long-term debt and capital lease. This is why it's upsetting. So what happens is they broke it apart because they had to. Maybe SEC came in and said like, hey, you got to freaking break this up and give more insight. And they finally did in 2019. New accountant came in or whatever. But for these 4 years, they just mixed it together, which is really stupid because when you go back and you try to study your long-term debt, you can't study it. So we will say this is their short-term debt. Apparently, they did not have any long-term debt. Okay. Their accountants are, this is what they were pulling. So you guys, this is what they were pulling. They were basically considering their capital lease obligation, which could be leasing airliners or airplanes, is what I'm assuming that this is. Because right here you guys see how it says long-term debt, capital lease obligation, long-term debt is 0. Is that I'm assuming that they're saying that their lease obligations for their airlines or for perhaps even the hubs at airports is their long-term debt. Again, fine, if that's how you want to define it. Not the correct way. But a lot of times with capital lease obligations, there's no interest rate. You're just paying that rent or you're servicing that lease. So what's happening is that they're defining it as long-term rent, but they're not paying interest payments. And so when our report is trying to figure out what they're paying for interest, it gets all mucked up. Does that make sense? Because you're dividing something by 0. And looks like they're finally doing a better job of breaking apart their long-term debt and their capital lease obligation, obligations. So you can see here in 2019, of that 2.8 billion in debt, only 1.8 of it is actually real debt, and then roughly 1 billion of it was capital lease obligations. That's it. That's how you dig through numbers. I know that sounds really complicated and crazy or weird because I remember when I first had to learn that, it was really nutty. But you know, it's just digging through the numbers. And you guys tell you guys the truth. Most of the time, it's the companies not reporting things correctly, or they mix numbers together like what they did right here, and it's just stupid. And what they should be doing is what they did in 2019, but they didn't do it for the previous 4 years, which is not cool and kind of dumb on their part. But anyways, let's jump back over here. So how we're going to fix this is we're just going to zero it out. It doesn't matter that much. And so what I'm going to do is what's throwing it off is this number right here. So I'm just going to assume that there isn't going to be interest on that debt for now, okay? Because we know that they do have, what is it, $14.46 billion in debt. But we are going to already account for it because, oh, I'm sorry, no, 11.42. We're already accounting for it up here under total debt. And this is another thing I'm going to get into a little bit deeper with you, is that when we're doing these valuations, we are looking at the company unlevered, okay? Unlevered in business means a company that without debt. So you're probably asking, why are you doing that if all these companies have debt? The reason behind that is because you're trying to value the core of the company. You're trying to figure out, like, we don't care about the debt for right now. We want to just see how fundamentally sound and profitable you are as a company without debt. Because when you throw in interest, like what we just had to do, interest payments, principal, short-term, long-term, current, capital, lease obligation, all that stuff, it like muddies the water and it kind of takes away from the true essence of a company. Because a company can also mess up with their numbers to show that they are profitable utilizing debt. And that's a whole other story. Just imagine if they released credit cards and they had interest income from credit cards. It's not the core business. Think of the Home Depot, right? They have a bunch of credit cards. They like, hey, buy this, do this, do this. And you buy stuff on their credit card. That interest is income for Home Depot. But that's not their core business. I don't want to be like, if they make $5 billion off, I don't think it's true, but let's say they make like $5 billion off interest because of the credit cards. That's not your core competency. I don't want to know that, so I take that out, okay? That's what we're doing here. So, but we do have to account that the company does have debt, and it's already factored in here. We're going to be subtracting that from the overall value of the company, okay? That's some insider baseball. I think I'm going to have to do like an online course or something for people who want to dive deeper into this. Anyway, so once we zero that out, you're like, oh, awesome, look at that. We're not done yet. We still have to do the sales growth. Remember, this is the most crucial part of the whole thing. And when you put numbers in here, it's okay for us to do like an axe-like precision right now. But if I really was going to be investing a large amount of my money, or really potentially put a significant amount of my portfolio into the stock, I would be pouring through the quarterly statements, their annual meeting, and really getting a better idea with what's going on. So what I'm going to do is I'm just going to go down here real quick, and I'm going to look at the revenue growth. And you can see Southwest is a pretty stable company. Pre-COVID, you know, they were growing right around 3%. 2019, it dipped off a little bit. I think that was because of the beginning of the coronavirus. I'm not sure actually. But you can see that they were growing at about 3%. So what we can do here is, based on the knowledge that we know now, what can we do for the foreseeable future? It looks like they topped out right about 3.5%. We know 2020 is shot. They're going to be negative. I'm not sure what they're going to be negative by. I'm going to make an assumption here, and I'm going to say that they're going to be negative 20%. Okay. Whoops, what did I do? That's not right. I want to do negative 20. There you go. That could be more, could be less. I'll have to dig into their financials a little bit more. They did not give quarterly. Can we do the quarterly? I don't think we do quarterly yet. Actually, let me just see this. So trailing 12 months, they're at 16. So just a really rough way of doing this. You see how this TTM stands for trailing 12 months. So we could do something very, very axe-like, and we can take this and look at the difference between these two real fast. Let's just do that. Let's say that that's roughly, what is that? That's 6 billion, 5.8 billion. So real quick, I'm going to do some really napkin math here. 5.8 billion divided by 22.43 billion. Okay, I wasn't too far off. That's about 26%. So we still have the holiday season around the corner, so there's probably an inch up a little bit more. But let's say that I'll give them minus 22%. So let's say they lose 22% this year. Okay? Next year, starting January 1st, let's hope that we get out of this pandemic a little bit, and let's say they go back to zero. They just hold steady. And then market comes back in full force. Let's say that they're going to grow like crazy. Let's say that they grow by like 10% the first by 2022, and then they're going to grow at 15%, and then they'll stable back out and they'll go back down to 3%. You guys see how I did that? Now these numbers aren't exact, and I can definitely dig into them a little bit more and flush them out. But basically what I'm trying to show here is that they took a huge dip this year. We know that for a fact. We just did the trailing 12 months. Next year, once everything kind of like, people are trying to get back into travel mode and stuff, it's just going to hold steady. And then once we come to the vaccine, hopefully within 2-3 years, it's going to shoot back up because everybody is going to be going back up. It might be even greater than 10%. It might be 20%, right? We can play with it in a little bit. The year after that, for sure the vaccine's working, everybody's healthy again, it's going to shoot up again. And then once they get back to a level spot, they're going to continue cruising at 3% because they are not a growth company. They're like a blue chip. They're like fixed, okay? So right now what that shows us is that right here, you can see about $56, $57 a share. They're currently trading at $40. So I should have bought a lot at 25. I should have done this a long time ago. But there's still value to be had there. So you can make back, basically, you're buying an undervalued stock. You're paying, let's say $40 for a $57 share stock. Now, before we do that, let's play around with these numbers a little bit and see how good it can get. So let's say that, this is assumptions again, but I'm burning this in, $57. Now when I'm playing, this is just me playing around. Let's say that Ebitda, they get strong, they get rid of their debt. They actually have, you guys, I actually really like Southwest now that I'm looking at it. They have way more cash than debt. They can pay off all their debt and still have $3 billion in cash. That's actually really good for an airline. So let's say that we give them a little bit better multiple. Let's give them like a 9 multiple. And let's give them a 4.5 discount rate. Let's go over the report. And let's say that next year it's actually not flat. Let's say next year it actually grows at 5%. And then the year after it shoots up 20. And then it shoots up, so we'll say 15, and then it levels out about 3%. Now we're looking at $80 a share. Okay, and now how I did that was I assigned them a premium, a good premium, because I just saw that they actually have $3 billion in cash if they took care of all their debt. I know that they are taking market share away from other airlines, and Southwest has one of the most lenient baggage. You know, the one thing I hate about United, US, and especially Spirit and Frontier is that they literally charge you for bringing your backpack on. Like they nickel and dime you, right? And their prices are just slightly better than Southwest. So Southwest, if they can take over a lot of that market, and we will have to see what they're actually doing, and you can figure that out if you listen to their annual meetings and you look at their quarterly reports, is that they could take it over. So I would say that this stock is valued somewhere between the 57 mark and the $80 mark. And just to double check that, let's go to one of my favorites, Simply Wall Street. And let's look at, let's see how close I got. You guys think I got close? Why is this not coming up? Love. What the heck? I don't know why that wasn't pulling up. All right, so we're saying 57. So we're going to go down here to valuations. Looks like they have, how many analysts do they have on this one? They have 17 analysts. Okay. I wonder who it is. Oh, that's cool. So it tells you the analysts. So JP Morgan. So these are big companies, okay? So these are the analysts that are looking at this. Let's go look at their valuation. Okay. So I wasn't too far off. It's more my closer one, my lower one. So $57 is my fair market value. They're coming in at $46.31. So this is really easy for us to do, just to kind of work backwards. It's called backward financial engineering, going backwards. is we just play with these numbers, and like I can probably actually kind of ballpark what they're giving, what they're doing for Southwest here. They're probably doing this. 2, 5. Whoops, did I do that right? 0, 10, 10. They might even do -30. There you go. So this is probably what they're looking at. So these analysts over here, they're probably looking at a -30% for sales growth this year, 0% next year, and then a slow climb back up. And they're probably giving them the ballpark of a 6% discount rate with the 6%, 6.5 times Ebitda multiple. See? Now, I can see that. If we were all sat in a boardroom and we were talking about that, I'd be like, yeah, you're probably right. But based on what I think, and I'm going to go do my reconnaissance this next month, is I think realistically, if they play their cards right, I think it's very realistic. I like their cash position is probably my biggest thing, is that they can cover their debt. Sales is going up. I think this is really going to be closer to 0.23. I think this will be closer to maybe, let's say, 10% growth. Because remember that 10%, they're diving down at 23%. So even a 10% growth, they're still stuck near that bottom of that valley. And I think they'll grow really fast in the year after that. I think they'll grow here, and then they'll bottom out at 3% again in year 5. So yeah, I'm saying the fair market value of this company, I'd say around between 60 to 80 bucks. 80 bucks is super high end. Everything goes absolutely right. And I think that really, very realistically, around the $55, $60 mark is a fair market value. And like I said, I already looked into it. I will be buying more. Yep. I will be buying more of Southwest. This is actually one of the best undervalued companies I've seen so far. By the way, I'm not a financial advisor. Don't trust me on it. Do your research. Definitely look more into it. But let's take a quick look at these graphs real quick. So we can see the unlevered free cash flows. Remember, unlevered means no debt. We can see their EBITDA. EBITDA, as it goes down, it's been dropping, so that's not good. Their profitability has been dropping. Remember, EBITDA's earnings before interest, taxes, depreciation, amortization. It's just basically operating profits. Revenues have been going up, so that's very odd. So we have to figure out, why are their revenues going up, but their profits going down? Because their COGS have been going up. So their cost of goods sold has been going up, and their SG&A has been going up. And then we take a look here. They're not spending a ton of money on capital expenditures, which tells me that they're probably leasing a lot of their airlines or their planes. Debt is pretty steady, and then obviously 2019 took a big punch. Common shares outstanding, they've been buying back shares consistently. Okay. So if anything I was going to do, I would dig in deeper of how come revenues were going up. You guys see this? This is what I would want to look at, is revenues going up, but why is cost of goods and why is SG&A, why are those two expenses increasing? And that's what I would dig in. And all that information is honestly, it's inside the annual report or the quarterly report. It's literally in there. You just have to read through it or listen to them on the sales call. And this is all through, just go southwest.com and I'm sure you can find it. Let me see. It's just usually under investor relations, southwest.com. So watch, we'll find it right here. You go into, just type in here, investor relations. Where can I find investor relations? And this is something that I recommend that you guys do for anywhere or for anything that you're about to invest in. Just like that, we found it. Here you go. Investor relations. So see, it tells you the stock price right there. And then upcoming events. So right here, boom. Q3 2020, Southwest Airlines, their financial results. So what's the date today? Next week, they're going to have their quarterly conference call. So you can listen in on this. This is a public thing, you guys. Okay? And let's see. Oh, speaking of dividends, do they have dividends? I'm all over the place. I want to look at their, they've got to have their old reports and stuff. Investor resources. Stand by, hang on. I'm looking this up. Investor resources. Shareholder service for details, direct deposit, dividend announcements, and actions. Is it this? View all events, maybe? Here you go. See? So you click on there, a little bit of digging, but you can see whenever you click on quarterly results. Boom, look at that. Look at that, you guys, right there. So you can go back all the way to 2015 and all of these right here. Fourth quarter, they're 10K, 10Q. So we can click on this real quick. And you can just read through this. I know it looks more daunting than it really is. But you can read, like, look at this. Southwest, their balance sheet, they explain their income statement. Let's see, notes to consolidated. They'll tell you exactly, they have to legally tell you what's going on. And so you can dig into exactly what's going on with the company. Okay, we won't bore you with that right now. But the point is it's easy to find. Okay, what was I talking about before? Yeah, so I would dig into COGS, SG&A, why revenues were going up, but why were expenses going up too? There's something going on there. Because it shouldn't be outpacing EBITDA. Because if revenues are going, sorry, I didn't mean to smack that. If revenues are going up, then EBITDA should also be going up. That doesn't make sense because these are growing. Yeah. Anyways, I'll have to dig into that later. So Southwest is a buy for me. All right. So you guys, what is going on? Hey, big up Penguin. What's up, man? Why does O'Leary invest heavily into dividend stocks versus growth? You know, O'Leary, he loves, if you guys remember, by the way, you're referring to Kevin O'Leary, right? Shark Tank guy. I'm not sure, but I can give you an educated guess. If you guys remember, O'Leary loves his principal, right? If you guys remember how he invested in Shark Tank, he always wanted his money back, or it was a loan. And he got a high interest rate, or he got royalties. Now, royalties is a thing that messes up a lot of entrepreneurs because when you think about royalties, you're like, oh, it's only 5%, it's only 2%, it's only 1%. But the thing that you have to remember is O'Leary is smart and he likes royalties because it is only 2% from your top line, from revenue. So if you make $1 million, right away, he takes 2% of $1 million. 2% of $1 million doesn't sound like a lot. What is that? That's $20,000 bucks, right? But you've got to remember, right off the bat, off the $1 million, you give $20,000 to this investor. Now you have to pay all your expenses. Usually, COGS alone is at least 50% of $1 million, right? So at least $500,000 out the door to pay for your goods. Now you have SG&A, which is typically another 30%. So you got $500,000 right out the door. You got another $300,000 out the door to pay for rent and your home staff and everything like that. You're at $800,000 in expenses. And then now you have to invest back in the business to pay for research and development, to pay for upgrades, new machines, anything like that. And then pretty soon you realize that your cash flow is only a couple tens of thousands of dollars. And you just gave away $20,000 to an investor. Okay. That's Leary's plan. That messes up, that screws over the entrepreneur, but makes him a lot of money. Now he likes dividend. He likes that monthly cash flow. And I think what he's doing is he's a smart investor. Don't get me wrong. And I think when you're investing in the hundreds of millions, maybe billions of dollars, I'm not quite sure how much he's worth, is that he can afford to stake out certain companies and know what companies are good. And even at a modest 4%, 3%, 2% on $100 million, what is that? That's $2 million, $2 to $5 million, just to invest in safe dividend stocks that he understands. I guarantee you he goes and plays golf and goes to the country club with the CEOs and the boards, or he's probably on the board of those companies. That's why he likes to invest in them. The reason why he doesn't like growth stocks is that it doesn't protect his primary investment. Okay, if he invests that, let's say that he has $100 million, which I'm pretty sure that he invests it in growth stocks like a Tesla, or think of what's the Nikola, right, the competitor, or he invests in Groupon or Twitter or anything like that, or Uber, right? The chances of him losing that $100 million is actually super high. Out of those companies that I just said to you, the only one that's doing well is Tesla, and it is so outrageously overpriced that any sound investor has pulled out their money and took their savings already, or took their gains already, okay? And so that's the reason why he would rather make a guaranteed $4 to $5 million a year passively and keep his $100 million nice and safe. I'm sure he's making way more than that, but that's my knee-jerk reaction. Okay. Other than that, you guys, do we have any other questions? We did it. We talked about whether you should invest in stocks or in real estate. I would say real estate if you're willing to work hard. I think that real estate, what you do now, it's very difficult for you to lose money 5 to 10 years from now. You would have to mess up really, really bad to actually lose money in real estate. But remember, your equity is very different than cash flow. You can be very rich on paper, like at the bank, the equity level, but you don't have cash flow. You got to find the balance in real estate. Stocks, you can make a lot of money real fast, but the chances of you losing that money is actually a lot higher than in real estate. And so I would say do both, but invest very smartly in stocks and very conservatively, especially right now in this overvalued, volatile market. Also, real estate, they're starting to show that it's softening. So it's going to be soon to be a buyer's market. Just check your local area. Do a zoom out on Zillow, and then remove boundaries. And then here, I'll do it right now with you. It's actually a good segue. So we go Zillow. And then let's just do a random city. I'm going to Austin, so let's take a look at Austin, Texas. So all you do is you remove boundaries. I was searching for land, so we'll just remove this too. We'll look for sale, and then look for what I was looking for: houses and then lots and land. So whatever you're looking for. Let's say that you're looking for condos, houses, and then maybe townhomes. And then you can just try and zoom around, and then if you find a spot that you really like, you can do this. Let's narrow it down a little bit because this is too much. Let's say like we do 500,000. And then what I'm looking for is I'm just looking for, Austin probably won't have it because it's such a hot city right now. I'm looking for recent cut prices, which I am obviously not seeing right now. Austin might be too hot. This might have been a bad example. Let's try another city. Let's try like, what's another one? Chicago? Let's try Chicago. Remove boundary. About here. You guys, I swear I was looking for properties and there were a ton of price cuts, and now there's like, I'm live streaming, there's no price cuts. I just had to do this research for the last video. Okay, there's one. So a lot of times when you highlight over it, like you see that $11,000 price cut. Typically, I swear I'm not lying to you guys, it usually shows up and it pops up, and it pops up all over the place with the price cuts. So sometimes you just kind of have to scroll through and look at it, and you just do this. That's what I normally do. Maybe it's just I'm in the wrong price range right now. Go back to Austin. Now you guys are just seeing me doing my this is what I do in my free time. So when I'm doing it, I'm doing this, lots of land. So look for multifamily, remove boundary. And then I'm looking just on the outskirts of Austin. Okay, so there's a 10,000 price cut there. And what you can do is, depending on your area, you can look around, and as you see more price cuts happen, you can tell that that area is softening up. But right now, there's another $15,000 price cut there, $10,000 price cut there, 5,000 price cut there. Is I would just do this every once in a while, and you can kind of get a gauge of the market. And obviously, if you're inside like a major city like in Austin, or inside like LA or Chicago, it might not work as much as another 5,000 there. Gosh, this is I saw way more. There's 10,000 there, 11, 12,000. Okay, so this is just me just browsing Zillow now. 7,000. So what I recommend is, if you're looking at buying a place in your first place, figure out, and you can even draw an area too. So watch this on Zillow. This is super cool. So obviously, if you can't afford something inside Austin, you can draw a circle around the area that you want, and then hit apply, and it'll give you just spots in there. And then you just go through, like what I'm doing right now. Is the first thing I always look for is I look for like good deals. So I'm just going to go through here. I might have to zoom in a little bit more. I'm just looking for good deals by doing this, or I scroll through here, and it'll tell you if there's a recent price cut. Which I don't know why it's not showing in. Maybe it doesn't show right here. And that's how I do it. All right. Do we have any other questions, folks? If not, thanks so much for tuning in today, you guys. We've been here, oh my gosh, it's already been an hour and a half. I love you all. Thanks so much for tuning in, guys. Everybody in the comments section, thanks for joining. We didn't have a ton of questions today, but I hope it helped you. Be careful dividend investing. And you guys know what? I'm going to go look at more in Southwest. If you guys are looking for a good opportunity, you guys have some money that you guys don't mind risking at the moment, is that I think Southwest might be a good company. Not a financial advisor, not telling you to buy anything, but thanks so much, you guys. I love you. I'm going to start posting Tuesday afternoons now on my video. Check out my next one. The next one I'm talking about, actually for all the students and all the folks out there who actually have a college degree or want to get a college degree, I'm addressing those folks because I've had a lot of questions about people what to study in college, especially during this time, the pandemic. So that's the next video, but I love you all. Check out my spreadsheet and like and subscribe. If you guys could help me out, I want some more likes. I would appreciate it. Let's try to see if we can get this to 20 before you log off. All right, I'll see you guys next time. Bye.